Hey, everybody, welcome to another episode of Real Estate Chat with myself, John Perez, and Robert Eid. And today we're going to be talking about a bit of an update with the recent numbers in September, what the interest rate is doing to prices, to sales. And we're going to put a bit of a spin on this because Robert is going to introduce an idea for quote unquote creative financing. So if you're looking to buy in this market, if you're looking to sell and you're looking for solutions for buyers to help ease in that that transition to purchase a home and make it a little bit easier to ease into in spite of what's happening in with everything that's going on in this market. There's an idea that Robert is going to share with us. So hey, Robert, let's start with we always go to these charts to show what we're looking at in terms of sales prices. So let's start with this one, and then we can use this as the springboard into or the launching pad for what we're going to talk about today.
Okay, well, this is projecting the whole month of September from the first half of September, saying the 5,200 sales will arrange. And we can see that instead of going up, it went down. So who knows? The second half could be much different, but I don't think so.
But you're basing this on, as of when did you run this?
September the 20th.
That's exactly right on there. So today being the 22nd, it's only 2 days in, 2 days since that. What's the likelihood that we're going to top August at this point? With only, a week or so left?
Well, again, it doesn't matter about August. It matters about last September. Like, what's the trend? Mm-hmm. And we were saying, okay, August is a blip or August is a new trend. And I'm going to say that August was a blip.
That's right.
And I have my own reasons that may be right or wrong, that people saw interest rates going up and said, I'm going to buy now, get my mortgage locked in before, first of all, Canada, then the United States, maybe Canada again locks in at higher rates. So we saw a great August, even though it's still off by 40% from what it should be. So everybody seems to have adjusted to a non-boom pretty readily. Mm-hmm. Buyers are being quintessentially buyers of making lousy offers and not wanting to go up. And sellers are being quintessentially sellers of saying, I want the most I possibly can. And what do you mean nobody wants to give it to me? And salesmen are scratching their heads saying, what am I going to do?
And so what we usually see is, I mean, when we talked about this in our last real estate chat episode, August doesn't typically see that much of a rise, but there were certain factors here. Could have been, for example, the anticipation of the interest rate hikes.
Yep.
Could have been just pent up,
Yep.
Are we going to do this? Or are we not? Or
yep.
What are we waiting for? But if we see this happen in September, then yes, it's kind of, you're seeing that we had a very quick fall market in August, more or less, and then now dipping towards the end of the year where it's supposed to be otherwise an active fall market. And if this happens in September, then what do you feel October will show as far as the sales trend? Will we see less than the 5,200-ish sales that we do see in September?
Well, we're going to putz along 40% less than regular. So if you see the regular, it's going to be 40% less than what it should be. And it should be better than September, because maybe some August was September that got dragged early. Exactly. And maybe July was lousier than it should have been. And maybe August was better than it should have been. There's a lag effect. People, as you say, are waiting. Mm-hmm. And then they can't wait any longer because, the kid's starting to do school, or I've got a new job, I got to do something. So I can't wait anymore. And you just have to deal with the situation that you're in.
Exactly. Interest rates are going to do what they're going to do, and that's out of our control. It's just a matter of, what's
adapting.
Exactly. Yes. Adapting. Perfect way to say it. Let's look at the next chart, which is, I guess, the same one, except with an over. Actually, no.
This is price. We're considering two scenarios on price. Every year for the last 20, the prices in September were 4.33% higher than the year before. And so if they do that this year, than the month before, up from the previous month. So August, September better than August. So if it does, then that curve for September will go up again, but it's still going to be 0.8 below the year before. It's this thing that I've been predicting that didn't happen last month. So in the best case scenario, I think of where prices go up by 0.4 or 4% in a quarter, in the third, then it'll be great. But it still won't be sufficient. There's the people who are watching that. What was it last year? That will have something to chew on if it goes up in the best case scenario, I say. And the one after that is in what I think is more normal to expect, which is for prices to be off by 2% from August. And then we'll have a lot of Toronto Star yelling and screaming about the world is coming to an end.
And it's really relative to because of what happened with 2021 prices. So if you look at the slope of the 2021, the line of it, basically it's increased year over year versus 2020 for obvious reasons, pandemic, pent up demand, supply dwindling. And so it would only make sense that it goes back to a natural growth or return back to the mean.
Well, this one has it here. This one underneath that blue line shows the change in a year. 12%, 18%, 19%, 25%, 24%. You can't have that. And so now we're seeing much more normal, +5, +1.8. Oh, it's gone through. Mm-hmm. So if it was too much, now it's going to be too little. Overswing. Gradually, it's going to straighten out to a new normal based on interest rates of, 5%.
Yeah.
No more 2%.
And that's a new normal. And considering the interest rates at where they're at now, if we still see the consistent price pattern that we see here on a seasonal basis year over year, it isn't too bad, right? So we saw a huge jump between 2020 to 2021. We're seeing 2022 return back to what a normal growth, as Robert pointed out, would have been. And so this isn't necessarily a bad thing considering where the interest rates are. The real question becomes something we can't answer today is maybe we can, maybe we can't, but it's speculation. If the interest rates didn't increase the way they did, would this be different? Right. And that's a whole other discussion. We'll skip that. Let's go to
They were too late. They were too late by 4 years raising the interest rates.
Right.
That's my view.
And so if they had done it, there you go. So if they had done it, then the price growth would have been normal. Pandemic would have been the only thing that would have thrown that off.
But that was 2 months.
It was 2 months, exactly. And then back to the usual pattern. So let's look at this one.
Okay, well, this is where it finally does break the line quite dramatically. And this is if prices fall 2% from August into September, and that gives us a year over year -7%, 6.9%. So this is where the Toronto Star will chew it up more than if it was the best case scenario of +4. So again, these are guesses based on the first half, and we have no input on prices. This is just what I'm bracketing is saying what's the worst and what's the best that we'll see in 2 weeks.
And it may fall in between that. And exactly, well, when you watch a recording 2 weeks from now, we'll see where it falls. And again, it's really hard to predict, if you will, exactly where this will lie because
safely, because this is the what everybody is wondering about. Every pundit on TV is saying, yes, it's great if it helps them, or it's lousy if it helps them. So everybody's just playing their own violin to help themselves and
guessing it, right? So when we look at these, and this is a great way to open up our discussion into creative ways of financing, and you're looking at buyers right now that they've seen another rate increase. Another one is anticipated later on. Well, it's in October, it's anticipated. Another one in December that's anticipated. Yeah. And if these rate increases continue their trajectory, it affects affordability because there is still a stress test. One of the things you and I always talk about. And there's still, of course, the usual qualifying criteria, the sentiment in the market that if I buy now, we talked about this long before it was ever mentioned, fear of overpaying versus back then during the pandemic and thereafter, the fear of missing out. So fear of overpaying, do I pay these prices or do I keep waiting? Mm-hmm. And sales activity is what we track in order for us to see what buyers are actually doing. And when you see that, buyers jumped in August. Now they seem to be a bit more cautious, anticipating what's to come. So let's look at creative financing, because buyers, to get them off the fence, if you will, they've got to look at ways to kind of ease into home ownership if they're first-time buyers. Yeah. We talked about during our office meeting today, there was a program where there's a co-equity or shared equity where
sounds great. Equity or participation. Yeah,
exactly. So companies are now helping buyers raise their down payment up to 20% by putting in a bit of a share and then taking when they cash out.
Exactly. It's an equity participation mortgage.
Right, exactly.
It's not for everyone.
It's not for everybody. There's
but
different
for
programs.
Someone who it is, it's great. It
Yeah, and
takes them out of CMHC financing.
exactly. So Robert, you've got a creative way of financing and an interesting way to structure this. So let's dive deep into that. I'll have more questions than obviously explanations. So I'm going to leave it to you to discuss that, and I'll ask you questions about it so that we can all understand what kind of creative financing can do to help buyers in this market and help sellers help their buyers.
Okay, well, this is the ultimate creative financing because in real estate, you're balancing the monthly payment, lowest possible for buyers, and selling price, highest possible for the seller. And most of the time, like what I think we're lacking in the market right now is the owner occupied, I've lived here for 37 years, wants to sell his house at home. Should I, or should I wait till next spring? It's always better in the spring. It's a little lousy now. They're saying it's boom. Like, what's next year going to bring? We don't know. And from the standpoint of a seller, you want to, especially in Canada where it's 100% tax free, you want to sell at the top price possible. And for years and years and years, we always had, people would arrange first mortgage, no problem. They get up to 75%, 80%, 95%, whatever they wanted at dirt cheap rates. And so there was no problem getting a cash offer. Where in the old days, you used to sell your house with the buyer's got 10% or 15% down. You'd get a mortgage for 75%, so that takes you to 85 or 90%. And then what do you do for the balance? The last 10 or the last 15. The buyer's not going to pay second mortgage rates, which is like way, way high. So the seller would take that mortgage, either to hold it forever, take the payments, or to sell it off to a mortgage investor who would buy it from them at 80 to 90 cents on the dollar. So nobody's doing that right now. But we're all used to normal blended monthly payments of principal and interest, which it's all set out what you're going to pay every month. You have a whole amortized schedule. There are other private lenders that do interest only, where all you pay is interest. The payment is a little bit lower because it's interest only. You're not repaying anything from the principal. Then you've got another old way, which is where you pay quarterly, a fixed amount, $1,000 plus interest on the previous quarter's worth of time. And you can work that out with a pencil, but you don't need a calculator and amortization schedule to figure what it out. Then seller take back, we talk, where to facilitate the sale, the seller will take back, often at a lower rate of interest, or if it's a buyer who cannot get a mortgage from an institution, he tells you up front, but he's got a good down payment, maybe it's at a higher rate of interest, but it's the only mortgage you can get, the seller gives it to him because he gets a higher rate of interest and he gets his selling price. So it's all about the seller getting his selling price and the buyer getting his monthly payments. So the quintessence, the end point of all of that fiddling around is the 0% mortgage. Now, how can you have a 0% mortgage? The whole idea of a mortgage is to spread it over time so that $400,000, $700,000, $1 million can be paid off over a long period of time because you don't have it today. So if you are not paying any interest, you're just paying principal, then you retire the balance very, very quickly. The whole idea is to find the right seller, which has got to be somebody who is just going to take that money and put it in the bank and get 4% interest on it and then pay tax on that. And say, instead of doing that, invest in the buyer that's buying your own house. All the laws of Ontario protect you as a mortgagee, a lender, and what we can do is have 25% come from the buyer, 25% come from a first mortgage, and you hold half the price as a second mortgage, but with a little wrinkle we call a wraparound mortgage. So you're sort of first and a half place so that, again, in Ontario, you can't lose your investment. You still own the house, title is transferred to you as mortgagee, and the buyer's payments are dirt. The buyer's payments are so dirt with a 0% mortgage, just like mortgage averaging. If you have a mortgage at 5 and half of it at 0, what's the average? The average is back down what everybody would like to pay. So there is a very rushed explanation of how a vendor take back for a seller who does not have to pay any tax on what he receives from the proceeds of sale of his principal residence can get a little bit higher selling price by offering financing that is impossible to get anywhere else. So that house becomes attractive because of its financing.
So let's pick this apart a bit for those of us, including myself, who have never gotten
Nobody has ever. Nobody has ever.
Yeah. So number one, if the first of all, it would be under the assumption that the seller has enough equity and has the capacity to be able to do this. So somebody who has bought recently and is now close to underwater or whatever have you,
He can't do it.
they
He
can't
can't do
do
it.
it. So
No,
that
this
that
is
goes
someone who owns their house virtually outright or has a mortgage of
or
less than
significant.
10%, and
Exactly.
that can get paid off with the new first that the buyer
Exactly. So
gives.
you've got to have, if this is you as a seller looking for, hey, how do I offload my house in this market? You've got to have significant equity to make these numbers happen. Otherwise, it's not going to work for you.
It's not for you.
Now, for somebody who does have that, let's say you do own your house outright
Yep.
because you bought it brand new back 30,
Yeah.
whatever years ago. Now you've got it, it's grown in value. You have enough money to buy, of course, your next place by virtue of you having paid off your mortgage. What's the incentive to make it a 0%? Now, obviously, I know the answer to this, but what's the clear explanation to, yeah, I could put my money into the bank or I could get a higher selling price. So, Robert, I guess for those wondering, how does a 0%,
Yep.
it's just like 0% financing when you lease a car or something, how does
Yep.
0% mortgage make sense to the seller? And why would they
Why would
lend
they do
out
it?
their money for 0%? What's their benefit?
Okay. One is getting a higher selling price for your house. And I'm going to pick a nice round number, $1 million. If you can give the buyer a 30% discount on what his payments are and get him to initially pay 20% more for your house, 1.2, and you do it for a 5-year term, the guy's got to pay it all out after 5 years. He's got to, part of it is a regular conventional mortgage, and part of it is this 0% that you just set up the payment schedule for, whatever it is, so that it ends up at the end of 5 years in the same place as it would be if he had a regular mortgage at 3% or 2.5% or whatever it is. You set it all up yourself. You just work out the math so that it suits the buyer, suits the seller. So there's no other way you can get $1.2 million. He's getting half of it in cash, and he's getting half of it at a rate of interest that he can't get anywhere else, which is 20% on the selling price of his house. So I think of it as a last time seller, which is the opposite to a first time buyer, who, what are you going to do with the money when you sell it? Well, I'm going to put it in the bank. Well, what are you going to do that for? You can put 400 in the bank, or you can put 600 in the bank in 5 years. Which would you like to do? Now, Canadians are not gamblers, so they might not do it. But there's going to be somewhere where you can apply this, and it'll just solve the problem so beautifully. You'll be amazed as a realtor. You'll be amazed at how it works. It's not going to work
So
every time.
it's built in basically. So it's not like you're doing a 1 million, it's a 1.2. And mind you, it has to appraise it, that it has to be worth it. But with the
No, it
shift,
doesn't, because you're only getting a
no,
50% advance. You're getting a 25% advance on the first mortgage. The guy's got 25% down. They don't care. The whole protection comes from the second that's held by the seller.
interesting. So good point. So is a 0% mortgage legal here in Canada? Like, are you allowed to charge?
Usually starts on about maximums. I think it's 18%, maybe it's higher, but no, you can do whatever you want.
Mhm.
It's your home. I can give you a loan at any rate I want for natural love and affection, and that's really what you're doing. It's not for natural love and affection. It's for a premium price paid in exchange for the real property that's in the middle of it.
Exactly. So it may end up, Robert, that the nominal rate or the actual rate that they're getting as a return on the interest may be higher than even a conventional mortgage, more or less. I mean, it depends on what the selling price is, right? So over whatever, like let's say you use your 1
Right.
million.
Without any specific numbers, you can't evaluate it A as a buyer, B as a seller, or as a third party looking at it for the very first time. But if you toy with it, you just find a situation. Make one up saying, okay, I have a buyer who wants to buy this house. How much would he have to pay if you put 25% down and got a mortgage at current rates? And where would he be at the end of 5 years? And let's say this is the agreed price. You just pick that agreed price, $792,000. Okay. Now, if you're going to put him in exactly the same position at the end of 5 years, at the end of an amortized 5-year loan, where is he? And he'll be better off with the 0% loan because of there's amortization on just dives down so quickly. The balance retirement, not amortization, the
Yeah,
balance.
and as I mean, as a seller, that would work for you because then you end up getting to sell your home. And this is not a common thing that can happen. There has to be certain circumstances that allow you to be able to do this. This may be a tough question to answer, Robert, but have you done a zero down mortgage?
Yes. This is how it came about.
Yeah.
That we
So
had
when
an
did you
adamant
do that?
seller, I've got to get this amount for my house. What are you going to do with the money? A guy over here saying, well, I just can't make any more payments. So first of all, for the guy over here, we got rid of his car loan, reduced his down payment, and we did his vendor take back second mortgage at 0%, and it all worked out fine. So
Recent, is this recent market or previous market
no,
when
this is in another crappy market that nobody could sell this beautiful house. And the guy had already sold his house in Pickering and he wanted to move over here. The numbers were much smaller, but it's the same
same
thing.
concept? And
12%
so,
first mortgages and a 0% mortgage maybe makes it seem much different, but it's the same because the principal amounts we're talking about is
and you can pretty much figure out based on those interest rate numbers what time period that was, right? And so
that's right.
what we may anticipate, and this is why this is a timely discussion, is we may anticipate that these kinds of solutions may be required in the market that we're about to face, right? So,
Correct.
I mean, there are situations right now where there are sellers that are stuck and they need to be able to deploy something like this, but it depends, again, on the seller's situation. Did they buy 5 years ago, 10 years ago, or 20, 30 years ago, right? And with the continued interest rate increases coming up, we may see more and more coming back to programs that either assist with the down payment, or if even that falls short, going to VTBs where the 0% makes sense because it's an incentive, and it makes things a little bit more stomachable for the buyer to be able to commit to the property. So thanks for that. I mean, it is a quick explanation. We could look at this in another episode in a more detailed fashion.
If anybody
for
asks a
those.
question, we will. If they don't, then we won't bother because there
Fair
has to
enough.
be real pain in the market for this to
Yes.
work. Where houses are sitting there for 57 days, 97 days, nobody wants them, all these showings. What do you have to do to sell it? And the person to be absolutely serious about selling it.
Absolutely. So thanks so much for that, Robert, and fantastic explanation of creative financing in the form of 0% VTBs. And if you have any questions for Robert or myself, please contact us. Our contact information is in the description. And next week, we're going to be looking at more exciting things that are happening. I don't know, exciting is the right word for it, but interesting things that are happening in our marketplace. And if you have any questions for us, feel free to give us a shout. Okay. Thanks for joining us on Real Estate Chat. We'll see you next time.
Very good.